Hey, thanks, Sam, and thanks to all of you for joining in today to hear about what I think could be referred to in banking as the $64,000 question these days, and that is, hey, can we still make balloon loans? And if so, on what types of transactions and under what conditions? So that's what we're here to discuss today. And as you know, these days, under the current rules that are in force right now, unless you have a high-cost mortgage loan under Section 32 of Reg Z or a higher-priced mortgage loan under Section 35 of Reg Z, it's pretty simple to make a balloon loan. And, of course, if you're talking about a business purpose loan, never a problem. Or if the loan, for whatever reason, isn't covered by Regulation Z, contract for whatever kind of payments you want. Even if it's covered by Reg Z, if the collateral is something other than a dwelling, no worries. But when you get into dwelling secured loans, even now, if it's a Section 32 or 35, then if you have a balloon loan with a term of less than 7 years, you're skating on thin ice, as we'll discuss, and it's about to get a whole lot stricter. Under the Dodd-Frank rules that take effect starting in January next year, you're going to have more difficulty making balloon loans. So today we're going to provide a little bit of context. We're going to talk first about the current rules for the various things. We'll go through and we'll talk about current rules, high cost, and then what the rules are going to be in January. We'll do the same thing for your higher priced loans, and then we'll talk about the ability to repay rules, the qualified mortgage concept, and the different special permutations of qualified mortgages under that. You can see on the bottom of page 1 that the restrictions on balloon loans are found in various parts of Regulation Z under the new rules, and we'll be talking about each of those. We'll talk not only about how it might be possible for you to structure a balloon loan that is compliant with the new rules, but we'll also talk a little bit about, so what happens if you don't? What happens if you go ahead and you make a balloon loan and you fall outside the permissible boundaries under Reg Z? What kind of liability are you looking at? So the purpose of this program is to help you understand what paths lead to compliant balloon loans under Reg Z, and unfortunately they're getting narrower and a little more windy. This is because of rules of the Consumer Financial Protection Bureau under Truth in Lending and Reg Z. The ones that we're talking about fall into subparts B, C, and E of the regulation and the commentary. So let's turn over to page 4 and start talking about balloon payment and how the term is even defined under the various provisions in Regulation Z. You know, the common understanding, as noted on page 4 of the materials, of a balloon payment is a payment that's more than 2 times a regular periodic payment. But the term itself, balloon payment, is actually used in 4 different contexts within Reg Z. One is where it talks about disclosing the payment schedule. You know how you have a need to disclose that it's a balloon loan. On that, under regulations that took effect, seems like January of 2011 or 12. It all blurs. And then you've got the term balloon payment used when Reg Z is discussing setting limits on terms for high-cost mortgages under Section 32. Those are your HOEPA loans. You've got the same kind of use of the term, but in a slightly different way on your higher-priced mortgage loans, your Section 35 loans, and then it comes into play in the new ability to repay loans as well as the old ability to repay under Section 35 and Section 32. So under your Section 32 provisions, there's a statement that says that if you have a Section 32 loan and the term is less than 5 years, you can't have a balloon payment. In other words, you can't have payments that don't fully amortize the outstanding principal balance. There's also a provision in the Section 32 loans that says that high-cost mortgage can't include a balloon payment, a payment schedule with a payment that's more than 2 times a regular periodic payment. And then in your rules that relate to disclosing the payment schedule, where they're talking about your need to disclose that it's a balloon loan, they define the balloon loan as, or the balloon payment as being a payment that's more than 2 times a regular periodic payment. And then they define it the same way in terms of the .43 provisions on verifying the ability to repay. Now, Jack and I were talking before the program started about all the terminology. So you got to get it out there in the beginning, and we'll be visiting different aspects of terminology as we go throughout the program. But we're going to start by looking at, okay, what are the current rules for balloon payments on Section 32 mortgages? And then we'll move to a discussion of how those change. So, Jack, talk to us about the current stuff.
Okay, be happy to. First of all, let me point out one thing in the manual. If you look at page 5 and the pages that follow, up at the top, the header says Current Coverage Rules, Section 32. Okay? If you switch over to page 8, the heading now has a gray screen behind it, and it talks about high-cost mortgages. All right? The stuff that is current rules has a clear heading. There's no screening. The stuff that's the new rules that will take effect next January has the gray screening in that heading. So that'll help you keep track on it. Are we in the current stuff or new stuff? Where are we here? That'll help. And let me also relay some comments that Mary Beth and I had. You know, we talked about doing this program a while back, and then, you know, we put the materials together, and the last day before the program, we'd sit down and kind of split it up. Okay, what are you going to cover? What am I going to cover? And we were talking about, just in general, the whole issue of balloon loans. You know, how do we get to this point? I made the comment, and I've been making it for years, that personally, I don't think I'd ever sign a balloon note. I mean, I work with bankers all the time. I love you guys. I trust you quite a bit. But if you sign a balloon note, your entire future is in the hands of that banker. If that, you know, if it's a 5-year balloon, for example, you make payments for 4 years, and then a balloon comes due and you don't have it, you're bankrupt. Then you got to sell your house to pay it off, or hit the lottery or something. Now, legally, I know that's the position. If the balloon comes due and the lender doesn't refinance it, you got to pay it. But the reality, and remember, I've been working with banks, generally small community banks, since 1976. And most of the lenders I've dealt with in that entire period of time were big-time balloon lenders. And I know the reality, while there's exposure on a balloon, it doesn't happen. I mean, if you go to any bank that's regularly doing balloon loans, I don't say any bank I've ever dealt with, if you look at their history of refinancing balloons or renewing balloons, they do. I mean, consistently, always. In the rare case where their financial condition has fallen apart or whatever, you know, yes, then maybe you don't, and, you know, you end up foreclosing on the house. But I don't think the likelihood of that happening is any higher on a balloon, than what it is on a 30-year fixed-rate loan. You know, if the borrower's financial condition falls apart on a 30-year fixed-rate loan and you're 5 years into it, you call it a fault, and